Hello and welcome to today's Delta Credit Tip. So you've been preparing to buy your home and fixing your credit and you're at the end. You can now go buy your house, but what loan type do you use? Because depending on which one you prepared for, you may not qualify. So stay tuned, we're going to fill you on all the different options right here on today's Delta Credit Tip. Hello and welcome back to today's Delta Credit Tip. I'm Michael Holmes of Delta Credit Restoration, bringing you yet more information to help you in your credit restoration process. Today we're talking mortgage types and what you're going to have to do to qualify for each one. Each one's a little bit different and you may qualify for one but not the other. So we're going to really dive into the different loan types. Hopefully you'll find this information helpful. If so, give us that thumbs up. Don't forget, subscribe and hit the bell so that every week as we come out with more information to help you in your credit restoration process, you get the information as we give it and it helps you right away. Right? So let's talk about these loan types because there's a whole lot of options out there. And like I said, each one prepares you differently. And once you're in it, it requires a very different set of behaviors on your part to maintain that mortgage. So there's really going to kind of break it down into three subcategories. The first subcategory we're going to talk about is government-backed versus non-government-backed loans. Then we're going to talk about fixed versus variable rate loans. And then we're going to talk about temporary versus permanent loans. Okay, so let's first start talking about non-government-backed loans. And these are typically what they call conventional loans. Right? So this means that the bank is doing all of their own decisioning. There's no government interaction other than the regulatory, laws that the banks have to follow. There's no credit score requirement put on by the government. There's no insurance requirements that are brought on by the government. All that stuff is strictly up to the bank. I am a huge fan of conventional mortgages. The number one reason is because over the life of the loan, typically your conventional mortgages are going to be your cheapest because you don't have to pay private mortgage insurance, which is basically an insurance policy that protects the lender in case you default, not you. And even if they do get a payout from the insurance, they're still going to come after you for the money anyway. So just to eliminate that altogether, you can go conventional because it's typically an FHA loan, a government-backed loan, that's going to require that for the life of the loan. Conventional loan only requires it typically till you reach at least 20% equity or profitability in your home. Now, the credit score requirements on a conventional loan can vary from company to company. It's not regulated or fixed like you would say with an FHA loan. So the credit score requirement as well as the down payment are going to vary from lender to lender. And it is not true that you have to come down with 10 or 20% on a conventional loan, right? I see them all the time as little as 3%, which is actually lower than FHA, and sometimes zero, okay? So you're going to want to shop around with different lenders because every one of them are going to have a different kind of criteria, right? And a different kind of palette on how they're going to want to treat your loan. Now, conventional mortgages can be what they call conforming or non-conforming. And if they're a conforming loan, then that means that they're still conforming to the guidelines of government-backed loans. And that just means that they can sell the loan easier after they've closed on it with you, right? Again, down payment, score requirements, debt to income ratios, all those numbers are going to be up to the lender. So having a clear communication with your lender when you're dealing with a conventional loan is key, okay? But that's going to be your non-government backed loans. There's also what they call a purchase money second. Now, a purchase money second is really what they call a home equity loan. And it's typically in what they call a second lien position. So you have a first lien and with your first mortgage and a second lien with your second mortgage. And a lien is just a paper that they file with the courts that says, hey, if he defaults on what he owes me or she, I can come after the house because it's now collateralized through this lien, okay? That second mortgage product you can put in a first lien position and make a purchase that way. The big advantages to that approach is that you can avoid a lot of the taxes, you can avoid a lot of the paperwork, but it's going to be, especially in this market, a little hard to find. But a purchase money second is where they're basically using a second lien product at a first lien position to make the purchase. Okay. Then you've got jumbo loans. So for our affluent people out there that are looking to buy mortgages that are typically over $514,400, you're going to have what they call a jumbo loan. And those jumbo loans typically have a much higher credit score requirement. Sometimes you may see that those loans are broken up into two parts. So you have a first and a second. This is what they call a combination loan. So that you'll have basically two loans to make the purchase of the one house. Because a lot of times a lender may only be able to go up to a certain dollar amount or something along those lines. But jumbo loans, they're typically they're above conforming limitations as far as dollar amounts are concerned. That's why they call them jumbo loans. But those are typically going to be your conventional loans for again for higher end clients. And then you have what we call reverse mortgages. Now, a reverse mortgage is a little bit different. You're already in the house, you're 62 years of age, you're coming thin on cash, and you need money. So basically what you do is you sell pretty much the house to the lender. And what the lender will then do is pay you either a lump sum or pay you over your lifetime while you're in the home. And even if the amount of equity that you have in that home gets eaten up over time and you're still alive, well, typically in those contracts, you're able to stay in that home regardless if there's any equity left or not, right? So those are, again, typically for people that are 62 and over. So those are your non-government backed loans, your reverse, your jumbos, your purchase money seconds, and of course, your first lien conventional products. All right. So now let's go on to our government-backed loans, and these are the ones that everybody's really familiar with, right? The number one being FHA, the Federal Housing Administration. So with these particular loans, your down payment is going to be fixed at 3.5%. So whatever the purchase price is, 3.5% of that, that's what you've got to come to the closing table with as your down payment. Okay. Credit scores are very, very lenient when it comes to FHA mortgages, and you can find them as low as 500 in some places, but typically 580 is going to be about where you're going to be. Now, as far as your debt to income ratio is concerned, they're going to usually cap out at 45%. These FHA loans are backed by the government, and they do require with them private mortgage insurance for the life of the loan, which can actually add quite a bit of money to your monthly payment going forward. So you're probably going to be introduced to an FHA loan opportunity by your lender only because it's the most prevalent one that's out there. If there's anything wrong with that house, though, if you've got roof issues, floor issues, plumbing issues, electrical issues, you're going to have other problems other than your credit going into the inspection. But FHA is by far the most popular because it has the low requirement and only 3.5% to get in. Okay. Then you've got your VA loans. Your VA loans are for veterans, and typically these loans do not have a credit score requirement, nor do they have a down payment requirement. But just like with an FHA loan, your lender that is contributing in this process can have what they call overlays. So not only do you have the government requirements, but you've also got the lender requirements laying on top. That's why they call it an overlay. So you will find that even though the VA does not require a credit score, your lender does. Okay, so make sure that if you're going to go VA, that you fully understand there are a lot of tax benefits to it. There's a lot of shortcuts in the beginning as far as how much money is going to come out of pocket, but they're not exactly the easiest loans to begin with. So make sure you have a very competent, experienced VA lender if you're going to go that route. Okay, and then last, you have what we call USDA. Now, a USDA loan started off as in the beginning as a loan for farmers, right? It's meant for very rural areas so that people can start to develop, right, land outside of the suburbs and the city. And a lot of times farmers were subject to varying conditions that most people aren't, like weather, right? And the fact that they need a bunch of land, and that land needs a bunch of work, right? So there's a lot more to a farm than there is to a single family unit, right? So there are breaks in a USDA loan, like zero down. But you don't necessarily qualify for a USDA mortgage. Your house does. It has to be within a certain area, and it is income restricted. So if you make $300,000 a year, you're not going to get a USDA loan, right? So there are income requirements, but more specifically, or more importantly, there are going to be location restrictions. So you're definitely going to ask your lender or your realtor if the houses that you're looking at or the area that you're interested in carries with it the opportunity for a USDA loan. Now, I will say on USDA loans, because there is no down payment, there is typically going to be a higher credit score requirement. So be cognizant of that. Make sure, again, you're communicating with your lender to make sure that you're going to qualify. All right. So we've talked now about government-backed and non-government-backed loans. Now let's talk about fixed versus variable rates. So most people are going to go for a fixed mortgage, and it's going to be typically a 30-year mortgage or a 15-year mortgage. The biggest difference between those two, obviously, is going to be the monthly payment. If you're crunching if you're doing a 30-year mortgage for $200,000, your payment's going to be one number. But if you shorten the term to half, well, then expect your payment not necessarily to double, but it's going to be more because you have less time to pay it off. So really, really do your math. Typically, I find that it's just better to go for the 30-year mortgage, and then if you have the capacity to pay it faster, there's nothing to stop you from making principal-only payments. At least then you're not obligated to go, and make the higher payment on a 15-year note. So go with the 30-year and pay it off faster, and you may find that you're actually going to save yourself a lot of money in interest because you're going to be canceling it on the back end anyway. All right. So you've got your 30-year and your 15-year, but keep in mind, you can talk to your lender about a 20-year or a 5-year or a 15-year or a 22-year mortgage. It doesn't really matter how long you go out, as long as they'll accommodate you. And really, you can dictate kind of how your monthly payment is going to end up based on the term. Make sense? All right. So you've also got what we call a 203K loan. Now, a 203K loan is for all of you that want to get into a home that's going to require work, like a roof or cosmetics, even new dishwasher or refrigerator. You can get a loan called a 203K loan that will give you the amount of the future assessed value. So they'll do an appraisal on the house as is. Then you're gonna tell them, okay, these are the improvements I'm gonna make. These are the price points on what it's gonna cost me, and this is where it should end up in value. And they will lend you that future value and just dole out that money as they see you make the repairs. So for those of you that want to invest, or maybe you're handy and you have the ability to kind of build on what you bought, a 203K loan is a great option. And then, like I mentioned earlier, there's also the combination loan. So, and it is still a fixed loan, but that's one that you're going to put on the back end to get a total loan amount to fit the purchase price. Okay, so those are your fixed loans. So now let's talk about variable loans. Now, I will start this with a caveat. I don't like variable loans. For the entire time that I've been a lender, I've never done an interest only or adjustable rate mortgage only because they're so super dangerous. Okay, so unless you're an investor, a savvy investor, or you're military and you know you're only going to be somewhere for a short period of time, these loans typically are not for the faint of heart, okay? The first type is an interest-only loan. And I like to refer to these sometimes as a balloon loan because they don't typically last 30 years. They're typically only 10 years or 20 years long, not even 20. Typically it's just 10. And during that time, you're only paying the interest. There is no principal payment requirement during this time. Thus, the biggest advantage being the tiny payment. But you're never paying down the house. You're only paying the interest, right? And at the end of that 10 years, what will happen is that you will be forced to either pay for the house in a balloon payment or sell it or refinance, right? So you're going to have to make sure that when the clock runs out, that you are 100% prepared to carry on a new note based on that time's interest rate. So interest rates 5 years ago versus interest rates now are a big difference. So whatever the interest rate is going to be when that time comes could make a dramatic difference on whether or not you can actually afford that house anymore. Because technically, if you got into it, back in 2008, they were basically saying, hey, you can't afford the full payment, just make the interest-only payment till you want to move out. Well, they never move out, or they aren't qualified to buy something else, and then they ended up in a foreclosure, right? So not a big fan of interest-only loans. Also not a fan of what they call adjustable rate mortgages. So with those mortgages, every year, every 5 years, 7 years, or 10 years, they have what they call an adjustment period. That in those increments, your rate will adjust. So if we're in an environment where interest rates are going down, which is not likely in 2020 because, well, it's 2020 and nothing goes our way in 2020, but interest rates can't really get any lower, right? So if you're going into an adjustable rate mortgage and you plan on being there for 10 years, the likelihood that your payment goes up is very strong because interest rates simply can't get any lower. Right? So wouldn't recommend necessarily an adjustable rate mortgage. Those mortgages, just like the interest-only mortgage, is going to balloon at some point, right? And there are certain caveats or addendums that you can put in that contract that cap how much interest or cap how much payment increase there will be between each adjustment period. But again, a very, very complicated kind of loan. And unless you're very, very sure of what your future holds, or you're a very savvy investor, not a really big fan of the adjustable rate mortgages. Another thing that can happen with an interest-only or an adjustable rate mortgage is just like we saw in the early 2000s, you can create what we call a negative amortization loan. So what that means is that when you buy your house, they amortize, or they put into a little schedule all your payments, one through the last one, right? So, and it'll tell you the dollar amount, the interest, and all that stuff. Well, on an interest-only loan or an adjustable rate mortgage, since you're really not paying the principal, if the value drops, you haven't been paying on the principal. So now you owe more than the house is worth. You're literally upside down in the house. And of course, that makes it very difficult to get rid of because now you're in a short sale situation and the bank is going to have to approve whatever dollar amount you're trying to sell the house for because it's going to be short of what you owe. And that's going to be very complicated to do. Okay? Those are your variable rate products. Now, the last product I want to talk about is what they call, which is a temporary loan, is what we call a bridge loan. You don't see these very often anymore, but a bridge loan is for those of you that are trying to move from one house to the next, right? And you're still paying on this one, but the payment on this one is not going to let you qualify for a payment on this one. And this one isn't sold yet or under contract. That bridge loan is a temporary loan to get you between the two houses. Okay, but you're gonna have to shop really hard for those. You're better just trying to coordinate the closings, maybe a simultaneous close or something like that. So again, there are a lot of options when it comes to your mortgage. Each one, depending on how much down payment you put down or whether it's government backed or not, will determine your rate, your monthly payment. There's a lot that goes into it. So you want to put some thought into it, especially if you're just now getting started fixing your credit or you're still in the process of fixing your credit. It could change how you do it. They have different debt to income ratios. You may find that you're going to have to pay down some debt on a VA loan, whereas an FHA loan you don't, right? Or on a VA loan, you can't have charge-offs, right? With payment plans. You just can't do it. But with an FHA loan or a conventional loan, you can. Or your student loans, right? If you have student loans on an FHA loan and they're deferred, they're going to take 1% of the outstanding balance as your payment if you're on anything other than a standard or an extended standard payment. Conventional will take whatever they say, and a VA will do 5% of the balance and divide by 12. So again, each loan is going to have a different requirement. So do your homework, find out about the different criteria of the loan, because again, having good credit and being lendable are going to be two different things, and you're going to want to focus on your lendability as you pick your loan type. All right, so hopefully again this information helps. If so, don't forget thumbs up, subscribe, and hit the bell. Tune in next week as we bring you more information to help you in your credit restoration process. And in the meantime, make a choice, make a change. Delta.